This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe Rabil, and what I'm going to do today is show you two different trade setups in different time frames that look, I think, almost identical. And I really just want to explain the fractal nature of the markets. And fractal meaning we can continue to slice them up. We can start with a monthly chart and slice that up and get a weekly, and slice that up and get a daily, and keep slicing it down. And we can see the patterns repeat over and over and over again. All right. I think you'll find this. Helpful. And I also wanted to show how we look at these two different types of trades. All right. Let's go ahead and get going. Now, if you have an interest in learning more about some of these techniques, I would suggest starting with the book. You can click the link in the description to find out more. Also, if you do enjoy this content, please hit the like button and also subscribe. Okay, so the chart setup is a little bit different than what we've had, what I typically show. On the top here, the top two charts are Micron technology, and I've got a daily chart on the upper right and an hourly in the upper left. All right. Now on the bottom, I've got the spider, and I've got a 5-minute spider on the right and a 1-minute spider on the left. All right. Now, if you look at the way this played out, we've got this consolidation pattern in Micron, and then a real dynamic move to the upside, and then we get a pullback, right? And then we have this consolidation pattern on the 5-minute, and then we get a dynamic move to the upside, and we get a pullback. All right. Pretty similar. I think those look pretty similar. If we go and look at what's taken place in the MACD in both situations on this move to the upside, we had a really strong confirmation, all right, of upside momentum. Okay. And then on ADX, we got a very strong reading in the ADX to the upside on both. And in fact, on both, the pullback stayed above the 25 line. All right. So in terms of just kind of generally looking at what, what is taking place here, I think there's a lot of similarities when we look at this. We look at this 5-minute chart in the spider and this daily chart on Micron. All right. Now, if we go over on the left side, you see what's taking place. We've got if we look at what Micron did, we went through this consolidation phase, had a pretty good up move up through, but it had overrun. All right. And so we don't take that first trade when we have overrun. So you could have been looking to play a pullback. Now, I mean, just based on that, let's just zero in on this for a second. Remember, this is an hourly chart. All right. And we're looking at this and we're saying, I personally have favored going into options when I trade. I do a swing trade like this, a daily, hourly, just because I don't like the overnight risk. I want to be able to put how much risk out there that I want to take. All right. I don't want it to be, a situation where it could gap against me and I just don't know how much I'm going to lose. Right. So I want to make sure I can cap that loss. And so it's what I like about the option. I can put up how much I want to risk, and that's it. All right. Now, you can see the way this played. Again, look at all this overrun, and you can see that the red kind of took over here as well. All right. So when we have that situation, there's a couple things we want to do. Number one, when there's overrun, we never really want to take the first signal up. All right. Like this is not going to be a trigger. We're not going to take that trigger. We're going to wait for, typically we're looking for the first test of the 18. All right. Now, when there's actually a lot of strength in the sellers where red takes over like this and causes the ADX to go above 25, then we're actually being a little bit more stingy about our entry here. We want to actually make sure that green DI is sort of getting back above and showing enough strength. All right. So in this situation, I have to say that I don't know that I would have taken this first pinch play here. This was the first signal, the first pinch. It broke the downtrend line, it moved up and then pulled back. I mean, if you took that, I wouldn't have a big problem. Green DI was getting back above, but I don't know that it actually really broke above. I guess it did. It was really close though. So I wouldn't have a huge problem with that. But the second, you actually got another opportunity. What's interesting about the way this played out is that we had 2 to 3 narrow range bars that took place right before this got the trigger going. All right. And we actually had a few here as well. So when you start to add up all these bars like this, you're probably shrinking the average true range a little bit. All right. And that might be actually improving what the options are doing as well. Now, that was a pretty big gap up and it's moving. So it might not, but what I'm looking for is an average true range that's dropping. The size of the bar is dropping. I like that. I want it to keep shrinking and shrinking and shrinking, because if I'm going to do the option, I want it to be, I want that to be calculated into the option. I want that the premiums to be lower. So we actually love to do these. I love to do options before they move at all. I mean, if you can find something that hasn't moved yet, right, but giving one of our signals and it hasn't really moved yet, that's ideal for the option. In this case, you're going to have to pay up a little bit just based on the fact that it had gapped up and then it had another move. But you just have to keep this in mind when you're going to do the option. All right, let's say you're doing this here, and let's just look at the price so I can give you a decent idea. Let's say you're entering right around 165.5. All right, let's just call that your entry area. I would, in this situation, number one, I'm going to go and I'm going to look at the bigger picture pattern. So I've got a 60-minute up. Let me first look at a daily chart. And as I look at this, I'm looking at 165.5. The old high is 169, 170, right? I've got to see a breakthrough. And based on the strength of the momentum on this higher time frame, there's absolutely I don't think there's going to be any problem with that, right? And we actually have a lot of strength even on the weekly chart. This was a part of a narrow range week. All right. So a lot of good things taking place from that standpoint tell me that I think what we should be on the lookout for is something that's going to break out above these prior highs, not just get to them. All right. Now, so I'm taking this into the calculation when I'm trying to figure out what option I want to do. All right. You can draw, you can draw your trend lines and draw in channels. You can do that. You can use a lot of different things to determine what you're thinking. But I'm typically, what I'm trying to do when I'm putting on an option is I'm trying to put the strike price that is out of the money when I get in the money when I get out. All right, that's where you're going to get big bang for your buck with moves like that. So I'd probably be looking at something like the 175s, maybe the 180s. Now, the 180s seem like a really far reach, and in this case now looking back, it wasn't, but when you do it, it feels like it's pretty far away. And that's okay. You don't have to go in the money. If it goes from out of the money, way, way out of the money to, pretty close to being in the money, let's say it gets into the high 170s, you're still going to get a really good bang for your buck in that type of trade. All right. So don't feel like if I buy this at 165, it has to get to 181 or I'm not going to make any money. That's not true. If you do the 180s and it goes to 175, you're going to make a lot of money in those options. They're going to move pretty nicely. All right, so just keep that in mind. I typically, when I'm doing this type of trade, I'm thinking 2 to 10 days is how much time I'm going to be in this. All right, so you could do an option that's just a couple weeks out. All right, you don't have to go too far out for this type of trade. Now, if you want, you could give it 3 weeks, and that's probably a little bit safer, but it's probably how I would be thinking about that. And then I would be taking big green bars. So let's say I do 5 of the calls in this or 3 of the calls in this or whatever, and I get this big green bar. Well, I'm going to take some on that first big bar here. All right. And then I might, depending on how I feel about it and how much time is left, I might try and see if I can't get more out of it. If I have 3 of them, I might take 2 on a big green bar like that and then just trail the last one and, use 2 bars on an hourly until I get stopped out, or a 2 bar low, or, if you've got more than that, like 4 or 5, something like that, then you could take half and then see how far it wants to take you. But on gap ups or big green bars and stuff like that, that's where you want to take those options. Make sure you're taking advantage of those. That's when the premiums are going to really jump with the volatility. All right, so use that to your advantage. And you don't have to you don't have to make the entire amount. If you don't get it to 190, it's not a losing trade. If you get in and you get out, anywhere in profitable territory around your strike price, it's a great trade. So that's what you should be thinking when you're doing these types of trades. You're thinking, I'm minimizing risk, or at least I'm capping the risk, because when I do this, I'm putting it on and I'm taking advantage of the lower time frame signal, right? And I should have really good timing on this. And then I'm going to take advantage of expansion. When there's expansion in the move, in the stock, I want to take full advantage of it and take profits. All right. So once we have that, we also want to understand that when we do an option, that we're trying to buy out of the monies that are going to be in the money or close to that by the time the trade is over. So that's the type of thing we're looking at when we're looking at our targets. That's what we should be thinking. Use momentum in your favor. If there's a lot of momentum behind the move, if there's significant momentum behind the move, and you're buying a stock that has really strong characteristics to it, don't just think it's going to go a little bit, all right? Don't just think it's going to get back to the new high or that, and then it's going to go down, all right? Use the next leg to the upside, and you can also go back. One of the things you can do, I've never really talked about this, but one of the things you can do that is a really helpful process is, so here's a leg, here, that was the leg before, all right? So you go through and you look at all of these legs, kind of count these up. Those are many, and they're kind of counter trends. So actually, ignore these two. All right. Think about the ones that are going to the upside. It's an up leg. That was an up leg. All right. And you can even do this one off the low. All right. That gives you about 1, 2, 3, 4, 5, 6. Somewhere in the area of 5 to 10. You go back in time. All right. And you figure out low to high, how big of a move these are making on average. Okay, so if you're having trouble kind of coming up with a target on a stock, you can go and you can figure out how much a move this makes on average. Now, you can see they're different every time, but generally speaking, we're going to get just kind of a ballpark feel, and it should be a little bit more conservative than the biggest move, right? And it should be a little bit bigger than the smallest move. And I think if you do that, it can be helpful. And if you want to do it in percentage terms, that's fine too. But just try and give yourself an idea of what you'd expect in the next leg to the upside. I think that's a useful process if you're just having a hard time coming up with a target area. All right, let's go down and look at what's going on the spider here, because again, I showed you the similarities. We had this strong move up, and then we got this pullback. We get the nice pinch play with very strong momentum. On the downside, we get the move to the downside with overrun. All right, we had some strength in the sellers again. I mean, that's why when I was looking at this, I was like, these are so similar. Really want to show this. You see how red caused, let's just make sure you can see this. This area here, red sellers caused the ADX to cross above the 25 line. All right, remember, green represents the strength of the buyers. The red represents the strength of the sellers. Negative DI is the red, plus DI is the green. All right, you need to know this. This is very important. The settings on this are ADX is the DI lines are set to 13. All right, and the ADX line is set to 8. The reason why I set the ADX line to 8 is because I want to see more peaks and valleys in the moves. I want it to keep up with the price action as much as possible. It won't be able to do it, but it does it a little bit better than a 14-14. All right, so we get this move up. Now, when we have this kind of selling, enough selling to cause the ADX to cross above 25, we need the green to come back and show strength again, which it did when it crossed above the 25 line, crossed above this prior peaking red. All right, now the buyers are back in command right at this point here, and we're looking for our next signal. We get our pinch play. All right, it's very, very similar to what happened to the hourly on the micron. All right, we get the move to the upside. Now, here's the problem with this. Now, if you're looking at this, you had a pretty good bar on the buy. Well, it was the bar before the buy, but you get on, you're in, and then you get this move, and you're up 3 bars, and this is actually a pretty big bar right at the prior high. So you have to kind of determine like how much you risked in this. If your average true range is somewhere down here, maybe even 1650, and you're here on your entry, well, this is actually a pretty good, that's 1-to-1. That's your first that's your first R, right? So you're hitting your first R there. It's not a bad spot to take a piece, all right? And even consider going to a break even. Now, why do I say that, and why would you do that after just 2 minutes? Well, I mean, for me, I look at it like it's just gravy for me, all right? If I'm doing longer term trades and I can add gravy to the, like literally I'm just adding crumbs to whatever I'm doing and my performance. I'm just, putting on these small trades, see if they can turn into something, and I can add crumbs to the bottom line, then I'm pretty happy with that. Now, if you only take a quarter, you still have 3/4 of your position to see what it wants to do. And, so you can take 2R and then see how it handles this. Now, the only thing I wanted to mention here is that I've talked about divergence with the DI. You notice how this made a lower high here, but this didn't make a higher high. This wasn't divergence. This was convergence. They're both making lower highs. Do you see how that? So it's still important. If this makes a lower high and this makes a lower high, it's still something that I would probably use a 2-bar low on. I would have been stopped out on this bar right here. When I say 2-bar low, that means once I see this diverging or converging where they're both in agreement, they're both, again, not necessarily in agreement, but we know that this isn't making a new high with this move, then I would consider just using the low of these 2 bars. So whatever the low is, so it would have been this bar, and then we get another bar here. Now we're below this bar here, and then we get this bar to show up. So now we're below these two, below this one, and we're below these two, right? And then you're finally, when you get below these two here, you're going to get stopped out on this bar. All right, so that's how you're going to handle that in this situation. Now, it got blatantly more obvious that we had a contraction phase developing where red DI was starting to come into play after this second peak here. So might have been a little, actually, I meant to, hold on a sec. Let me just show you this next peak. So this next peak is really where it got a little bit more blatant. You see how green DI dropped down below 25, and then we came all the way back up, tested this high. We didn't actually make a new high, so there's never really divergence. Well, there was, because if you notice, look at what the ADX did on the second move, and DI clearly came all the way down and could make a peak above 25. So this is getting down in the nitty-gritty a little bit. This is probably a little premature when I think about it, because we don't know that it's divergence until after that it's convergence until after the fact. So you're probably waiting and you're seeing what's going on here. You're seeing all of this drop off in the buyers, to me, and you're also seeing the sellers starting to show up. To me, that's good enough, and I would have been stopped out again somewhere in this region, and that's not really what I wanted to talk about. What I wanted to talk about mostly is that we're looking at a situation where we get in at 10, like between 10, let me go back, 10 o'clock, it's a little after 10, 10:05, 10:10, somewhere between there and 10:30, I would say is where the 5-minute, 1-minute trades are going to show up. It's just where they show up. If you're doing 5-minute, 1 minutes, it's where they're going to happen. So if you showed up and you started looking at the S&P, or you started looking at, some of the biggest leaders of the day, between 10 o'clock and 10:30, you're going to, starting at 10 o'clock, you're going to start to see some of these show up. All right. Now, the point I wanted to make is if you make a profit and it's somewhere around 11 o'clock, don't go looking for another trade. All right. We're getting into 11:15 is where you really start into like 11:15, 11:30. You're starting into the midday doldrums. You can see how it changed. Everything's sort of flopping around here from 11 o'clock all the way through the lunch hour. Pretty much nothing happened there. And that can actually keep going until about 1:15, something like that. Now, you notice how the action, 1 o'clock, look at how we got all the action started at 1 o'clock. So you got to be very careful about doing a lot of these trades in this region. Now, if you're doing a 10-minute chart, it's very possible that it's going to show up between 11 and 11:30 or something like that. That's okay. It's a different type of pattern. It's a little bit longer pattern that's going to allow for a little bit more movement. But I would prefer, and this is the reason why when I show a lot of these intraday trades, I like to do the 5-minute, 1 minute, because I really want to be done by 11 o'clock. I don't really want to get into this anywhere in this time frame. I just would rather not mess with it. That's for you day traders out there. Again, I'm not really a day trader anymore. I don't do it all the time. But if I were going to, I would be doing it off a 5-minute and a 1 minute, and I would be trying to get done by 11:15, something like that. All right. Let me know if you have any questions. See you next time.